Hello guys, this is Investing for Kids by Kid Part 2. In Part 1, you learned why it's important to invest and what asset classes are, like stocks, indices, ETFs, etc. In Part 2, you're going to be taking a look at how to analyze a stock, what drives stock prices up and down, and you're also going to be looking at how to use a stock screener to find the stock that's best suited for your portfolio. Enjoy the video. What moves stock prices is our first topic today, and it's going to be about what makes it go up and down. So it goes up and down pretty much on analyst reports. So JP Morgan, for example, may give an analyst report saying that this company is doing good or its future predictions for the company, and that may affect the price, for example. If JP Morgan bumps up the rating of one of its public companies and says stock X is doing better than we thought it would be, maybe more people will invest in the stock and whatnot, and that may drive the price up. Next up is earnings reports. They're given every single quarter or every 3 months by a publicly listed company like Apple or Amazon or Google, for example, and they just have to talk about how they're doing, what the earnings are right now, and how much money they're making, that kind of thing. Now, earnings reports are given out by companies because the SEC, or the United States Securities and Exchange Commission, forces them to, because they want to make sure that no deceptive or fraudulent behavior is happening to investors. They just want to make sure that public companies aren't cheating their investors. It also may go up and down about news about the commodity, saying that the company is doing good. Future predictions, like for example, Apple may release a new iPhone in the next 2 months. That kind of thing may affect the price too. Next up, we're going to be talking about how to analyze a stock. Analyzing a stock just means looking at the stock, figuring out whether or not it's worth your time, whether or not you should buy it, and whether or not it has a place in your portfolio. So the first method is using news, kind of like what I just said about looking at news, looking at upcoming predictions and concerns, like Apple may release this new iPhone when. And this news may be associated with your gut feeling that, oh, I have a feeling it's going to go up. That gut feeling, sometimes you should tune it out of your mind and sometimes you should listen to it. It all depends on the scenario. So you should definitely read news and understand a company, because you cannot just simply look at a chart and say it's gone up and then it's gone down the last 11 times. Maybe it's going to do the same thing this time. Because believe me, that's a very risky way to bet on the price of a stock. Instead, looking at the news and understanding the company is a very thorough method to do it. That just segues me into the topic of past data does not guarantee future results. So that's just trying to show here. We'll pull up a graph. Sorry about that. This is Apple. We'll pull up a graph of the last 2 years. We cannot say that Apple has done this much in 2018, so it's going to be doing that same amount in 2019. There's definitely no correlation. Just because a stock did this much doesn't mean it's going to do that much in the next year. So you'll see this kind of past data does not guarantee future results. That a whole shebang when you sign deals to invest in mutual funds or hedge funds, because they want to make it clear that they're advertising that they've done so well in the past. They want to make it clear that they may not be able to do the same in the future. And so pretty much that's a disclaimer you'll hear a lot in your life, in your investing life. Now, method 2 is looking at charts and the analyst report. So I'm going to exit this browser over here. First thing we can go into is market cap. Market cap is pretty much, we'll go to summary. It's, as we stated last lesson, it's the size of a company. So if we look here, this is Cisco. Never mind. I'm going to be using Cisco for another example. Let's use LMT, which is Lockheed Martin. This is the market cap, which is used to identify the size of the company. Normally, companies that have bigger market caps may be just a little more stable at sometimes, because if they have a big market cap, then if something goes wrong, they're not going to be completely screwed. That's what I'm trying to say here, is that companies that are early, that they just had their public offering and they just had their stock released on the exchange, they may be a little more risky because more people are looking into them. The market cap is small. There's higher demand for the stock. More people want to buy it when it's low. That kind of thing. So that's why I'm saying that stocks that have a higher market cap are generally not as risky. Next is volume. Volume is pretty much how many orders happen, or how many orders happen in a day, for example. So volume here, this is on a heavy, I'm pretty sure. It's saying here around 1 million orders, or around 1 million times does Lockheed Martin or LMT get bought or sold. It doesn't matter. It just matters how many times has LMT switched hands. And it's around 1 million. Now let me show you a nightmare case about volatility and volume. Our volatility, let's just call it risk for now. I'll define its actual term later. But LMT has a small volume in compared to its market cap, which means that it's usually going to be stable. But if we look at a stock like Peloton here, it went up 4.72% today. Its market cap was 8.343 billion. That's very small, but its volume is 5.899 million. That's actually more than Amazon's volume. And Amazon is a company that's close to being $1 trillion. So I'm just trying to show here that the volume is so high, but the market cap is so low, and that's the formula for 4.72% volatility. Or when I say 4.72% volatility, I mean 4.72% price swings. Volatility is just how big the price swings are, regardless of what direction they go. So we would say Peloton's a very volatile stock because it's 4.72%. That's a huge amount. Usually stocks go up 1 to 2%, or they lose 1 to 2% in the day. But 4.72% is quite big on the daily for Peloton. Next up, we'll look at value. Now, value, I just want to exit this and I want to go to Morningstar here. Now, Morningstar is an investment research center. Unfortunately, it does cost money, I'm pretty sure. But our library provides it for us, so that's a great resource, though. And if you can't pay for Morningstar, don't worry. There's definitely other platforms you could use to do your own research and to figure out which stocks are good for you. Let's look here. Value. Sorry, I got distracted. FB. Let's look at Facebook Inc. A Class A shares. If this can load, yeah, here it is. 3 stars. Morningstar gives it a rating, and here it's showing that it believes that the fair value is $200, and its last close, or its last the price of when the stock market last closed was at 209.78. So that's just showing here that by the last close, it's already more than the fair value. So, and since it's roughly $9 apart, it's considered fairly value over here. Now, this is just to show that you want to buy stocks when they're low or when they're undervalued, and then you want to let them grow and then buy them. You want to buy low and sell high. You don't want to buy overvalued stocks. Now, if you want an example of a stock that's very overvalued, it's Apple. It's Apple. Let it load. Says, see, Apple is significantly overvalued. It's at 300.35. It actually broke the record today on January 2nd, 2020. Its fair value is $220. So you can see that it's clearly overvalued. So I'm just trying to say here, you want to buy stocks that are undervalued, not overvalued. But that may not necessarily be the case, because if Apple keeps on pushing from this 300.35 and it goes up to $400, then you may be regretting saying that, oh, I didn't buy it by that time. So again, stock markets have different scenarios that require different kinds of thinking. You cannot just say that this kind of situation covers all. Now we'll go over here. Oh, my bad. We're gonna go to dividends. Apple, we can use TD Ameritrade for this one. Here, APL, we'll use Apple as an example. Apple annual dividend is 1.05%. That means every single year it gives out a dividend of 1.05% of its share price. So dividends are pretty much, the definition is, some companies would want to incentivize investors to invest in them. So what they would say is, if you buy a share, we'll pay you X% of that share back to you for every share you buy. So Apple is going to pay you 1.05% annually for every share you buy of Apple. They'll pay you 1.05% of the price. 1.05% of 35 is 3.08, around that. So I'm just trying to demonstrate here that dividends are given out by companies to incentivize shareholders to buy it. Normal dividends are in the range of 1 to 2%. 3% is considered high, and anything more than that, there's definitely something going on, and sometimes you shouldn't just trust the dividend alone. For example, I'm just going to demonstrate an example here. This is on Apple stocks. CSCO, this is Cisco Systems. Let's look at the all. Its market cap is very high, volume is pretty high too. But let's look here, okay? This is 2002, and since this is 2020, January 2nd right now, it's only gone up 186%. That's very small. But its dividend is pretty high though, 2.92%. What I'm trying to prove here is that Cisco is a matured business, meaning that when I say it's matured, I mean that it's found its key partner to its core industry. It's found what its core industry is, what it needs to sell, that kind of thing. So Cisco knows already what it's doing. It's matured its business. It's not looking to expand anymore. So rather than trying to expand that much, it's more focused on giving money back to its initial shareholders, and that's what it's doing with the huge yield. So I'm just trying to show you guys that the dividend yield sometimes can be high when the actual growth of the stock is low. This is a common example for matured businesses and stocks that boomed in the 2000 .com bubble. Stocks that boomed here, they have now matured, so they may give high dividends now. Now, there's something called dividend investing, where you specifically invest in stocks like Cisco that give high dividends. And another thing is that a 10% dividend seems very high, but there's stocks that give 10% dividends when their share price is $10. So you always want to compare the percent of the dividend to the share price. So we've already gone over dividends. Volatility, we've briefed over it. It's pretty much the level of the price swings. Next up, we want to go to peer comparison. Now, the reason peer comparison is such an important thing is because in peer comparison, you're comparing it to other stocks in the industry or in that sector. Now, when you look at an earnings report by Apple, you want to make sure that if its earnings reports seem low, you want to see, are there any stocks that are in the same sector of Apple, of IT, as it says here, technology, hardware, storage, all of that stuff. You want to see, is other stocks doing that same way? Are other stocks in that same industry, are they going down to in earnings? You want to compare the earnings, not necessarily to the earnings and the growth. You would not necessarily want to compare them to the S&P 500, which is the biggest 500 company average. You may want to compare them to the industry average to see how it's doing. That may give you a better picture of whether a company is beating the industry. So Apple, we've already used Apple too much. We can use Google, for example, or Alphabet, my bad. This is GOOG Alphabet. And these are all Fit's competitors in the interactive media and services industry. So here, this is the growth rate, I'm pretty sure, with the 0, 100%, 200%, and 300%. And it's just showing how much the growth has been. So here we can see that SNAP, or Snap Inc., is gone up the most in this interactive media and services industry. So you definitely do want to compare not just the stock price. You want to also compare other things like earnings ratio, how much money they're making. All of that you want to compare in the industry sector. Next up, we'll use analyst reports. I'll go to this window. And just to make it clear, this is, if I haven't stated this already, this is the investing platform of TD Ameritrade, and this is Thinkorswim, which is TD Ameritrade's trading platform. So this is KO, Coca-Cola. This is the earnings report right here. This is the research team which tells you to hold. CFRA tells you it's a 4-star stock. The Streets tells you to buy it, and Market Edge tells you to neutral from avoid, pretty much meaning you should keep it. They're mixed about it, pretty much. You should hold it or you should avoid it, something like that, around that area. And when you're looking at these earnings reports, most people trust them because they're made by the pros on Wall Street, of course. And you should look for the most recent one. As of this video, it is January 2nd, 2020. So this one's the closest one, and it's saying to hold. Or this one's the most updated, the most accurate in that sense. So earnings reports are used when you're trying to figure out whether or not a stock is going to go up or down. But I wouldn't necessarily say that someone should just blindly look at the earnings reports. They should definitely read it. I know it can be quite hefty reading through all of this. But if you do, it is useful though. For example, like here, Coca-Cola eyeing new markets such as sparkling water, diet soft drinks. All of this could impact the price, as I said earlier, and all of this could be a reason why you would buy or sell the stock. Next up, we're going to talk about using stock screeners. We'll go to Morningstar for this, and here we'll just go to Home. And before I talk about using a stock screener, I'd just like to define what it is. It searches criteria on you. Searches stocks on criteria that you decide. So it's going to look at whether or not the stock is fair valued, is it undervalued, overvalued, that kind of thing. And it finds what you're looking for. It finds the hidden gems of the market. Because like Apple, Google, Facebook, I'm a culprit of this, but I've mostly mentioned the big name companies like Coca-Cola, for example, Lockheed Martin. But I also do want to show that there are so many other stocks that could easily provide faster returns than Amazon and other big names. So don't necessarily think that the big name stocks are the best stocks. There's plenty of other stocks that have higher growth than those big, huge name stocks because of their huge market cap. And those are stocks that may be actually worth more of your time to put money into. Now, this is Morningstar. Here we'll go to companies. This is a screener. First thing we'll use view all data. We'll go click here, and I'll show you this on the Thinkorswim platform too, because I really do want to show you guys both platforms. And here, this is greater than or equal to. Let's select a number. We'll make it 0.7 for right now, and we'll click OK. And then it closes the tab, and then it searches all the stocks. 500 and this amount of stocks past that screen. So we'll click here, we'll view the results, and we'll see all of these stocks that view our results. And it's tedious going through these 500, like these 5,000 roughly stocks. And so let's say I don't like 3 stars, I like more 4 or 5 stars. So I'm going to go to the stock screener, and we're going to do that. Let's do that again. So here, view all data. We'll go to the stock screener. We'll add 2 conditions now. Now let's add the value of 0.7 and let's add 4 stars. And let's see if anything comes up that's like what I want. Now let's insert another one here. This one we'll use Morningstar's rating. Greater than or equal to. We want it to be, let's say, 4 stars. Okay. Now I'm gonna cross my fingers that some pass the scan. 115. Okay, that's not bad. Here we'll look, and then we get all of these stocks. I'll open this one up: AMC Networks, BlackBerry, and then this is really, if you do this tedious work, this is really where you get stocks that actually will pay off more than maybe stocks that are the big names. So here, AMCX is significantly undervalued. And you also want to look at stuff like economic moat and stewardship. Both of them just pretty much mean economic moat and stewardship. They just refer to how well can a company keep its proprietary information to itself, and how much can a company stay competitive to other companies. So is there anything that AMC Networks has over other companies that prove that AMC is better? Does it have a better service? Does it make a better product? What's that competitive edge to other competitors? And that's definitely something you want to see. So here we see that the moat is narrow, which means it doesn't really have a competitive edge. You can, I'm not going to go through this, but you can always select all of these features on Morningstar and figure out which stocks have the best moats, which ones are the best value, and whatnot. And I'm just going to show this briefly. This is on the trading platform. A stock will put the yield at 5%. That's pretty big. And maybe we'll choose volume. We want it to be two. That's like roughly 200,000, something like that. Yeah, and then we'll scan, and then we get all of these stocks. So this is really how you find the hidden gems of the market. So now that we've gone over stock screeners, it's time for us to recap. And recapping pretty much because you're almost halfway there. Congratulations, you're almost halfway there to being the best investor you know of yourself. And so I just like to recap everything we learned and everything you learned in part 1 and part 2. So part one, what you learned was what stocks were, their individual shares of companies, bonds, an IOU with interest, ETFs, mutual funds, pooled capital again, traded every single second, indices, ETFs that track an industry or mutual funds that track an industry. Mutual funds are pooled capital, and then you pay a management fee, and then they invest for you pretty much, actively managed fund. Part two, what you learned were what the forces of the market were, what causes the stock to go up and down, analyst reports, earnings reports, news, that kind of stuff. You also learned volume, number of times a stock changes hands, number of buys and sells that happen in a day. You learned volatility was the level of the price swings, like that 4.72% price swing by a Peloton. You learned what dividend yields were. Dividend yields pretty much the incentive by shareholders to make you invest in their company, and they pay you that amount of dividend or that percent for every share you own. You also learned about the example of Cisco, of the tale of how Cisco has low growth on the actual stock, but it gives high dividends. You learned about fair value versus last close. You want to buy low, sell high. You want to buy undervalued stocks. And then you also learned about analysis reports on how to use them, and also peer comparison as a bonus. You always want to check everything to the industry average. Hello guys, thank you so much for watching that video. Hope you enjoyed it. If you learned anything new, please hit that like button and put any feedback as usual in the comment section below. Also, feel free to just subscribe to get the newest updates and the newest videos, and share this video to anyone you know who might be interested in investing and learning how to grow their money. Thank you.